Is it possible to invest your money safely in 2024, especially as a beginner? This question might be keeping many of you awake at night as you ponder the labyrinth of investment. After all, the world of investing can seem like a daunting, risky place for those who are just getting started. The fear of losing hard-earned money or being scammed, the complexity of financial markets, and the sheer variety of investment options can all seem overwhelming. But let's clear the air right now. Investing doesn't have to be a game of high-stakes poker. With the right knowledge and strategies, it can be as approachable as your neighborhood grocery store. The key is to understand that not all investments are created equal. Some carry significant risk, yes, but others are designed to be safe harbors, providing steady returns over time. Fear not, for today we will be exploring 5 safe investment methods for beginners in 2024. So, what are these 5 safe investment methods for beginners in 2024? Let's dive right in. First up, we have the diversified portfolio. As the saying goes, never put all your eggs in one basket. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help reduce the risk of a major loss. It's like a safety net for your investments, ensuring that even if one sector takes a hit, your entire portfolio doesn't crumble. Next on our list is dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. Over time, this can reduce the impact of market volatility on your investments. It's like a slow and steady race, where consistency can lead to significant gains in the long run. Then we have bonds. Bonds are loans, or IOUs, that you make to a company or government in exchange for regular interest payments plus the return of the loaned amount after a specified period. They are considered safe because they provide a steady stream of income and are backed by the credit of the issuer. The fourth method is investing in index funds. These are a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. They provide broad market exposure, low operating expenses, and low portfolio turnover. They are considered safe due to their inherent diversification and passive management. Finally, we have real estate investment trusts, or REITs. These are companies that own or finance income-producing real estate. They allow individual investors to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. REITs can provide a steady income stream and are considered safe due to the tangible, physical assets they represent. And there you have it, the 5 safe investment methods for beginners in 2024. Let's take a closer look at the first method, diversified portfolio. Picture a table laden with a variety of delicious foods. That's what a diversified portfolio is like, but with investments. It's a mix of different types of investments like stocks, bonds, real estate, and more. The purpose of a diversified portfolio is simple. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you're reducing the risk that comes with investing. If one sector or type of investment takes a hit, you're not left high and dry because your other investments can help balance out the loss. Think of it like a safety net. It's there to catch you if one of your investment choices doesn't pan out as you'd hoped. It's a strategy that works well for beginner investors because it helps manage risk while still offering the potential for growth. A diversified portfolio allows you to spread your risk, making it a safe option for beginner investors. Bonds and index funds, 2 more methods that offer safety for beginner investors. Let's start with bonds, shall we? Bonds are essentially IOUs issued by entities like governments or corporations. When you buy a bond, you're loaning your money to these entities for a predetermined period of time. In return, they promise to pay you interest at fixed intervals and return the principal amount at maturity. This makes bonds a relatively safe investment, as you can predict the returns you'll receive. Pivoting to index funds, think of them as a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track a particular market index. This could be anything from the S&P 500 to the NASDAQ 100. The beauty of index funds is that they offer broad market exposure, low operating expenses, and low portfolio turnover. They are designed to keep pace with the overall market, not to outperform it. So while you might not hit a home run with index funds, you're also less likely to strike out. So why are these two methods safe for beginners? Well, bonds offer predictable returns and index funds provide broad market exposure, which helps to mitigate risk. These features make them a perfect fit for those dipping their toes into the investment waters for the first time. Bonds and index funds are low-risk options that can provide steady returns. Last but not least, let's talk about real estate investment trusts, or REITs. Now, what are REITs, you ask? Well, they're companies that own, operate, or finance income-generating real estate. They work somewhat like mutual funds, allowing both small and large investors to acquire ownership in real estate ventures. So how do REITs work? They pool the capital of numerous investors. This makes it possible to purchase a diversified portfolio of real estate, ranging from office buildings to shopping malls, warehouses to apartments and even hospitals. As an investor, you buy shares in the REIT, and in return, you earn a share of the income produced through real estate investment. Neat, right? Now let's talk about why REITs are considered a safe investment method, especially for beginners. Firstly, REITs provide high dividend yields. This is because they're required by law to distribute at least 90% of their taxable income to shareholders annually. Secondly, REITs offer the potential for capital appreciation. As property values increase, so does the value of your investment. Lastly, they offer diversification, as they're not directly correlated with other types of investments. This means, when stocks go down, your REIT investment may not necessarily follow suit. REITs offer a way for beginners to invest in real estate without the need for a large amount of capital, making them a safe and accessible option.